Banking secrets the rich know, how to protect your wealth. Introduction: Understanding the banking system. The banking system may seem like a safe and reliable place to store your money, but beneath the surface, there are significant secrets that often go unnoticed. Henry Ford once said that if people fully understood how the banking system works, it could lead to a revolution. Unfortunately, the general population lacks financial education, contributing to the vast wealth disparity we see today. To change this, one must understand the banking secrets that the wealthy use to their advantage. In this discussion, we'll reveal how banks make money off of you and what you can do to prevent them from taking a large chunk of your wealth. Footnote: This section introduces the premise that most people don't understand how the banking system operates, which leads to the extraction of wealth, particularly through high interest rates and poor financial education. History of the banking system. The concept of banking dates back as far as the 7th century BC in Babylon, where the first bankers emerged, lending money at interest. The first banknotes appeared during this period, and they were equivalent in value to gold. The word bank itself comes from the Italian word banco, meaning table, as the early banks operated in offices where they exchanged large sums of money into smaller denominations. The first private bank, established in the 12th century, marked a significant shift in how banks interacted with governments, beginning with large-scale credit issuance. Over time, banks became central to the economy but were simultaneously viewed with suspicion, as many saw bankers as greedy swindlers. Footnote: This section traces the history of the banking system, showing how it evolved from early money lenders to private institutions issuing large-scale credit, while maintaining a dual perception among the public as both a necessary financial tool and a potential threat. Banks don't store money. Contrary to popular belief, banks do not simply store your money. The reality is that the interest rates offered on deposits are often too low to even cover inflation. For example, in Switzerland, the best banks offer a deposit interest rate of only 0.5 to 1.5%, while inflation typically averages between 1.5 to 2%. As a result, the money you deposit loses value over time. Banks, however, make money by lending out your deposits at higher interest rates, effectively profiting from the difference. Additionally, governments also benefit from this system, as it allows them some level of control over citizens' money. Footnote: This section explains that banks don't store money, they lend it out at higher interest rates, creating profit by using deposited funds while the depositors receive minimal returns. Banks serve themselves. At the heart of the banking system is the simple truth that banks are primarily serving their own interests. The money deposited by customers becomes an asset for the bank. Even when customers take out loans, that money remains the bank's asset. The bank's goal is to maximize its own profit by leveraging deposits for loans, while customers are left to navigate fees and interest charges. Banks will never advocate for the individual depositor; instead, they fight for higher returns on their investments and greater control over assets. Footnote: This section highlights the fact that banks prioritize their own profits over the well-being of their customers, treating depositors' money as an asset to be leveraged for financial gain. Banks don't lend money to those who appear poor. A key feature of how banks operate is the way they assess loan applicants. While banks claim to provide access to capital, they often judge customers based on appearance, especially when a customer lacks an established bank account. If a person appears to be struggling financially, banks are less likely to approve loans, even if their financial situation doesn't necessarily reflect their potential. Conversely, wealthier individuals, who may not need loans, are often more likely to receive them because of the perception that they are less risky for the bank. Footnote: This section points out how banks assess borrowers, often providing loans to wealthier individuals while denying loans to those who may appear financially unstable, regardless of their actual financial health. Bankers' annual bonuses and loan approvals. In the banking world, the loan approval process is influenced by more than just the financial stability of the applicant. Bankers receive annual bonuses based on the number of loans they approve. This incentivizes loan officers to approve as many loans as possible, particularly towards the end of the year when bonuses are on the line. While these incentives may seem like a way to motivate employees, they also mean that loan officers may approve loans with less scrutiny than they would at other times of the year, in order to meet their quotas and secure bonuses. Footnote: this section reveals that bankers' incentives to approve loans are often tied to their annual bonuses, which may encourage less scrutiny and lead to potentially risky lending practices. Banks make money on you and your name. Banks utilize their customer database as a valuable resource, often converting this data into new financial offers. Additionally, they frequently sell customer data to other financial institutions or companies engaged in microcredit. Banks also generate revenue through credit card fees, where they charge customers hidden fees for using their credit cards. These fees, known as shadow taxes, are often unnoticed by consumers but can add up significantly, as banks inflate prices to cover these costs. Footnote: this section discusses how banks monetize their customer data and charge hidden fees through credit card usage, contributing to their revenue without transparent customer knowledge. Better terms for the rich. Banks, like any other business, exist to make profits. As a result, they are more likely to lend to wealthy individuals who have the assets to back up their loans, reducing the risk for the bank. Wealthier clients provide more collateral and can cover losses if they fail to repay the loan. For this reason, banks offer better loan terms to the rich, who are considered less risky for the bank, while poorer individuals are left with less favorable conditions or even denied loans altogether. Footnote: this section explains how banks favor wealthy individuals by offering them better loan terms and conditions, due to their ability to provide collateral and reduce risk for the bank. Conclusion: managing your finances. While it is unrealistic to avoid working with banks altogether, it is crucial to understand how the system works and how to manage your personal finances effectively. Instead of relying on deposits that provide minimal returns, it may be better to invest your money in businesses or other forms of income-generating assets. Furthermore, using cash instead of credit cards can help avoid hidden fees like shadow taxes. The key is to recognize that the banking system, while essential, often works in favor of the banks and not necessarily the consumers. By becoming financially educated and strategically managing your wealth, you can protect yourself from the hidden pitfalls of banking. Footnote: this section wraps up the discussion by encouraging viewers to be mindful of how they manage their finances and to consider alternatives to traditional banking to avoid hidden fees and interest charges.